Thank you, Gabriel, not Gabriel. Thank you very much. As you mentioned, my name is Joshua Obengele. I'm the risk manager at African Guarantee Fund. African Guarantee Fund, I'm going to speak briefly about African Guarantee Fund just to demonstrate, because yesterday on this screen I saw there were two questions. Is it time for credit guarantee schemes for Africa, and the effectiveness of credit guarantee schemes for Africa? So I prepared, I think, about 3 slides, very brief, just to demonstrate that credit guarantee schemes are actually working for Africa. So I'm going to use a live example of AGF. Just to introduce AGF, AGF is an international private guarantee fund. Was established in 2015, though started operations, in 2011. Those started operations in 2012, and we built up the portfolio. I mean, the take-up was slow in the beginning, but as we went by and by, as the market started becoming aware of our existence and of our products and the benefits that it provides, especially to the financial sector, we saw our outreach levels really picking up very fast. So we'll see in terms of impact what that has done, not to us, to the financial sector, as well as to the wider society and the economy. Gabriel, if you allow me to call you that, has gone really into the technical details, which is good. But I know for the audience here, you probably want to understand what's the benefit for us in terms of, if you are financial institutions, what's the benefit of us taking credit guarantees. So we're going to talk about this and explain what benefits accrue. Yeah, so in terms of our model, I think I better look there. In terms of our model, we mobilize capital from various parties. You'll find that our ownership or shareholding structure is a mixed one, is a blended one. So we do mobilize, we have certain classes of shareholding. So where first loss class is left to the government and a couple of donors. We have a second tier of ownership where we invite DFIs and several other donors to take shares. And then the third tier is basically left for the private sector. So financial institutions and high net worth individuals. These are these what you can call third loss, because these are the people who are conscious about making a return. So if you keep them at that level, then they gain comfort to come in and participate at that level, on a third tier level. So we mobilize capital, and we use that to unlock and channel private capital from financial institutions to SMEs. So our key partners are the financial institutions. We share risk through partial guarantees with the financial institution to enable access to finance from mainstream financial sector to the SMEs. You will understand that one of the key problems that SMEs find is accessing credit from the mainstream financial sectors. And this is because of various issues, but one key one is the perception of high risk. So there is this notion or perception that the SME segment, and for good reason, is a high risk segment. And we have seen this in various, even as African guarantees, when we were setting up, certain feasibility studies were done before we set up. And we found out that perception is real. So that is the key element that prevents financial institutions to actually aggressively go into the SME segment. That's where we come in to provide various products as African Guarantee Fund to drive impact. Our key objective, or ultimate objective, really, is to contribute to poverty reduction. I mean, reducing poverty, as well as sustainable economic. We manage as well. Now, this is basically a tool that we use for all the partners that we provide guarantees for, to build capacity within the financial institutions in terms of gaps that exist when we're doing our due diligence. We find gaps that exist in terms of skills or knowledge around lending towards the SMEs, the processes and policies that are inherent within, that are being used by the banks or financial institutions to lend to SMEs. We also have systems. Do they have the correct system, lending systems? We can use this fund to then help build the capacity within the financial institutions, and eventually, I mean, ultimately that leads to a lower risk. Us taking a lower risk, we can consider then pricing based on that in terms of the results that come out of our capacity development interventions or initiatives. Having said that, what are some of the, I was given a few minutes, so I think 5 minutes. I want to go to the next slide, but let me see if I'm missing out something here. Yeah, so that's our model. What is the advantage? I think at this point I should also mention we have private guarantee funds or credit guarantee schemes. We also have public credit guarantee schemes. There are pros and cons for each. We know the history of credit guarantee schemes in Africa, and of course also in other, in the what we could call developed world. Especially for Africa, there's been a lot of failures of credit guarantee schemes. Understandably, this Africa, I mean, came into the game a bit late. Around 1960s is when Africa really woke up to credit guarantee schemes. And the initial schemes that came in at that time actually were not, they didn't have the benefit or to understand how the entire scheme framework works. So we had a lot of failures, but bottom line, the key thing was the differentiation between public and private. Most of the schemes in Africa were public, government owned, directly owned, most of them, some through private entities or government owned entities. So you find the success rate was quite low. Even today, the kind of schemes we have in Africa, if you look across the regions, Africa, you have schemes that are still owned by government but are still struggling for various reasons. I think our colleague here will be able to touch on that a bit. I mean, he's from government. But the advantage, one key advantage of a guarantee scheme, as opposed to direct line, getting a direct line from an investor or funder as a bank, is you can leverage under a guarantee scheme. So for $1, $1 of funds that you'll receive directly from a financier, a credit guarantee scheme can be able to make you lend 8 times that, $8. And because, for example, if we take for African guarantee, we leverage 4 times our capital. So the $1, if you invest it in AGF today, we leverage it 4 times, meaning you can issue guarantees of up to $4. And that is only 50% because our risk cover, our coverage ratio for all guarantees is a maximum of 50%. So if you double that, it becomes $8. So we can create more impact through credit guarantee schemes, or financial institutions can have more impact through credit guarantee schemes than accessing direct funding. My last slide, just to explain some of the guarantee products we have on the market and what they help solve within the credit market. We have a bank fundraising guarantee, which is basically a guarantee that helps financial institutions access long-term financing, either directly through borrowing from financial institutions, other financial institutions or DFIs, or through to support the issuance of bonds by the financial institutions. We know that traditionally financial institutions have had short-term finance, and they've used, some of them have used short-term finance to do long-term lending, hence creating mismatches. But with this guarantee, then we guarantee the investor, the lender, the person you're borrowing from, to provide you this long-term financing to enable you then on lend long-term financing to the SME segment. It is the long-term funding to the SME segment that has impact rather than the short-term financing. because this enables them then to invest in long key assets, yeah, like machineries, plants, and all that. And this then eventually creates jobs and eventually has a positive impact on the economy. This again helps reduce the resource gap. There are certain gaps that within the SME segment that exist. You have resource gaps, we have skills gap, we have information gap, we have the access to finance gap. So all these challenges that SME segments go through are one way or the other addressed by the sort of guarantees that credit guarantee schemes can provide. And so I think Africa needs to embrace credit guarantee schemes. The loan guarantees, of course, are a direct guarantee to the financial institutions to help them, to help them lend to SMEs that lack collateral or support their unsecured portfolios. It could support also secured portfolios, but where you have insufficient security, then the loan portfolio or loan individual guarantees will help address the collateral gap, as well as the high risk perception gap. We have a unique one equity guarantee gap, guarantee that helps the SMEs access equity capital from private equity funds. So we guarantee the private equity funds to invest equity into the SMEs. And lastly, as the tool I mentioned, the capacity development funds, which provide to financial institutions as well as to SMEs, which basically helps address the skills gap and as well as the perception gap. Now, I don't want to belabor the fact that credit guarantee schemes are critical contributing to the positive development of the economies within Africa. But I will just give a snapshot of what our credit guarantee scheme, the kind of impact it has created today. These are figures that exist as of today. We started from, I think in 2012 or 13, sorry, with 9 countries. Our guarantees were being implemented in 9 countries. Today we are in 40 countries across Africa. Our mandate or scope is to cover the entire Africa. Our guarantees have managed we have managed to partner with just about 137 financial institutions across Africa, and we have enabled access to finance to 21,000 SMEs across Africa. We have issued guarantees of up to $1 billion today, which has enabled or made available credit to the African SME segment of $2 billion. Out of the $2 billion that's available, $1.5 billion has actually been drawn down or disbursed. So the estimated number of jobs that our guarantees has created is estimated as 120,000 jobs, 125,000 jobs maintained. 30% of the SMEs that we have supported with our guarantees are actually women-owned or women-led. The tenors also a critical component, and this is where additionality, he mentioned about additionality. We have financial additionality and economic additionality. So the tenors, we started with the tenors of around below 24 months. Today our tenors have grown to be almost 60 months. We are about 55 months today. So there's been a growth in tenors. So that is what we call financial additionality. And then we have, through our capacity development arm, impacted or trained 2,200 staff of financial institutions. 60% of the guarantees that we've issued have been to youth-led or youth-owned SMEs. 11% of our portfolio is green, so we have a unique guarantee we call the green guarantee, which we developed, and so far 11% of our portfolio is a green guarantee. 84,000 households through the green guarantees have been connected to solar, and this has helped minimize or reduce emissions, carbon emissions, to the tune of $8 million. I want to leave it at that. I see Gabriel is really on my neck, but we can discuss further. Thank you very much.